Welcome back to the deep dive. Today, we're diving headfirst into PACCAR Inc. That's PCAR for those following along. They're a huge global player in truck manufacturing. Yeah, think Peterbilt, Kenworth, DA over in Europe. Our goal today, using the great sources you sent over, especially that detailed Compasscope report and the Q2 2025 earnings call, is to really unpack the investment picture for PCAR fast.
Right. We want to get beyond just, truck sales numbers.
Exactly. Understand what drives their profit, where the risks might be hiding.
So we'll take it step by step.
Yeah.
First, the core business model. Then how they stack up against competitors like Daimler and Volvo.
Okay.
Then we'll look at their growth strategy, which is, pretty conservative.
Yeah.
Gauge the execution risk, fold in the latest Q2 results.
And wrap up with the key things you need to keep an eye on.
Exactly. Should be a good overview.
Okay, let's unpack this business model then. So at its heart, PACCAR designs, makes, and sells commercial trucks. We're talking Class 8 heavy duty, but also light, medium, and the specialized vocational trucks too. But like you said, just calling them a truck maker doesn't quite cut it, does it?
No, not at all. They're really more of an integrated industrial group. They've got 5 business lines that work together quite synergistic.
Synergistically, okay. So the main one is obviously truck manufacturing, selling the actual Peterbilts, Kenworths, DFs.
Right, that's the big revenue driver, but it's also the most cyclical part. The real stability comes from the other 4 pillars supporting it.
Okay, so let's talk about what some analysts say is maybe the crown jewel.
That would have to be the aftermarket parts business, PACCAR parts.
Mm-hmm.
It's just a massive stream of high-margin recurring revenue.
High margin?
Oh, yeah. They sell replacement parts for their own trucks, obviously, but also, and this is key, they sell parts for other brands' trucks under their TRP brand.
Ah, interesting. So it's almost like a buffer against the ups and downs of truck sales cycles?
Precisely. It provides this fantastic financial cushion. It delivers, really impressive profitability and resilience.
And supporting that, you mentioned PACCAR Financial Services, or PFS.
Correct. PFS handles the financing side, retail loans, leases, and also financing for the dealer's inventory.
Okay.
And one thing people sometimes miss is they run about 13 used truck centers around the world. They just opened a new one in Warsaw, actually.
Why is that so important, the used truck centers?
Because it helps them manage and maintain high residual values for PACCAR trucks. If the trucks hold their value better, it lowers the total cost of ownership, TCO, for the customer.
Right, and TCO is king for fleet buyers. That's a big competitive edge if your trucks depreciate less. Okay, what about under the hood? Engines.
Yeah.
They used to rely a lot on outside suppliers, didn't they?
They did, but that's changing. The Powertrain and Technology division is key here. They develop their own PACCAR engines, specifically the 11-liter and 13-liter models. That's the vertical integration piece.
Gotcha.
Plus, they're working on the next-gen stuff too, electrification, so EV and hydrogen, and also ADS, the driver assistance systems.
And the fifth piece tying it all together.
That's the customer and dealer support. Basically, that global network of over 2,000 service locations. It keeps the whole ecosystem running smoothly and reinforces that brand loyalty.
Okay, makes sense. So we know what they do. Now, the competitive landscape. PACCAR versus giants like Daimler, Volvo, Traton. Where does PACCAR really stand out? The Compasscope report hits hard on their financial strength first, right?
Absolutely. It's probably their defining feature. They operate with what people call a fortress balance sheet. Basically, zero industrial net debt.
Zero.
Zero net debt on the industrial side. And they're sitting on a huge pile of cash, around $10 billion.
Wow.
This lets them return a lot of capital to shareholders and just, ride out the downturns much better than competitors.
Okay, but isn't there a risk that $10 billion in cash is, well, maybe a bit lazy,
Yeah.
especially when rivals are pouring money into EVs?
That is the central question for PACCAR strategy, I think. Right now, their advantage is that financial discipline plus the resilience of that high-margin parts business. And also that growing vertical integration with their own engines. They're putting their 11L and 13L engines in about a third of their North American trucks now. That helps margins and part sales down the line.
Okay, so financial strength, parts, engines. What are the big challenges or weaknesses compared to those rivals then?
Well, 2 main things jump out. First is the cyclical nature of the truck market itself and their concentration. They're heavily reliant on North America's heavy-duty market. They have about 30% share there. In Europe, their DF brand is more like mid-teen share, so it lags a bit.
Okay, concentration risk. And the second?
The second, and it's a big one, is the potential technology lag. PACCAR's investment in EVs and autonomous driving has been, let's say, more measured, more conservative compared to rivals like Daimler and Volvo who are spending very aggressively.
So, boiling it down, PACCAR is the super efficient, financially solid operator. Daimler and Volvo are maybe playing a longer game, going harder on global scale, and leading the charge into EVs and autonomy. That's quite a strategic divergence.
It is. PACCAR is essentially betting the transition to new tech will be gradual enough for them to catch up without having to make huge, risky upfront investments right now.
Okay, so if their growth strategy isn't about splashy acquisitions or going all in on EVs immediately, where does the growth come from? You said it's disciplined.
Yeah, highly disciplined. It really starts and arguably ends with that parts business. They're forecasting high single-digit annual growth there, maybe 8% CAGR.
Right.
And that's driven by the simple fact that there are more PACCAR trucks on the road every year. And more of those trucks have PACCAR engines needing PACCAR parts.
So they're just steadily growing that installed base and reaping the recurring revenue. Makes sense.
Exactly. The second lever is pushing that vertical integration further. Using more of their own engines reduces reliance on suppliers like Cummins and boosts profitability.
Uh-huh.
And they're serious about it. They're building a new engine remanufacturing plant. Should be running in early 2026, aiming to rebuild 5,000 engines a year. That extends the whole value chain.
Extending the life cycle. Okay.
Yeah.
And geographically.
Steady expansion. Growing their presence in South America and Asia and expanding the aftermarket distribution network, they have 20 distribution centers now, including that new one in Warsaw we mentioned.
So it's all about efficiency, marginal gains, expanding the existing model, not really moonshots,
Precisely.
which leads to achievability and risk. This disciplined approach, it clearly lowers the execution risk, right? Less chance of a big M&A deal going sour or betting the farm on unproven tech.
Definitely. Their execution risk profile is much lower than peers, generally speaking.
How so?
Well, look at the contrast. Daimler and Volvo. They face higher risks because they're pouring massive money into R&D. Daimler's around 5% of revenue trying to scale up these EV platforms profitably, which is still a big question mark.
Okay.
Traton, which owns Navistar now, has significant integration risks, plus the challenge of getting all their brands onto common EV platforms. Even Cummins, the engine maker, faces risks as its customers, like PACCAR, bring engine production in-house.
Right. So PACCAR avoids those headaches. But the flip side is that strategic risk we talked about.
Exactly. PACCAR minimizes the short-term operational bumps. Their main execution challenge long-term is really twofold. One, making sure customers fully embrace their proprietary engines. Two, ensuring their slower EV pace doesn't leave them behind if battery costs drop faster or charging infrastructure pops up quicker than they anticipate. They could lose share.
Okay, let's pivot to the latest updates. The Q2 2025 earnings call from July 22nd. It was a slowing market, but PACCAR still posted revenues of $7.5 billion, adjusted net income $724 million.
Yeah, and the strength, again, was really outside the core truck building. PACCAR Parts had a record quarter, $1.72 billion in revenue, and fantastic pre-tax income of $417 million.
Wow, the margins on that.
Incredible. They hit 30% gross margins on parts in the quarter.
30% in
Wow.
heavy industry. That just shows the power of that business.
It really does. And interestingly, management guided for Q3 parts growth to accelerate slightly, maybe 4% to 6%, even while saying the overall replacement parts market out there is pretty flat.
So they're gaining share or commanding price.
Likely a bit of both. And PFS, the finance arm, also did well. Solid pre-tax income of $123 million. Credit quality remains strong, and used truck values are holding up, especially for PACCAR brands.
Okay, looking forward then. Q3 outlook, they're guiding production down a bit, 32,000 to 33,000 trucks.
Right, that reflects the usual summer shutdowns in Europe and some rate adjustments in North America. Pretty standard seasonality.
And margins.
They guided Q3 gross margins for trucks around 13%, but that assumes the current tariff situation doesn't change, which adds some uncertainty. But here's the key bit. Management seemed to suggest that 13% could be the bottom of the margin cycle for the truck segment.
Ah, calling the bottom. Bold. Why the optimism for late 25 and into 26 then?
They pointed to three big drivers you should know about. First, that U.S. infrastructure bill, what they call that One Big Beautiful Bill Act, they see it providing $300 million to $400 million in cash tax benefits, which helps their customers' bottom line and encourages orders.
Okay, legislative tailwind. What's number two?
Number two is huge for the cycle. The upcoming 2027 ONX emission standards from the EPA, they're drastically cutting the allowed nitrogen oxide emissions from 200 milligrams down to just 35.
That sounds like a massive technical challenge.
It is, and it's expected to add significant cost to new trucks in 2027 and beyond. So the expectation is a big pre-buy where fleets rush to buy current spec trucks before the deadline. That likely starts heating up next year, 2025, and runs into 2026.
Got it. Creates an artificial demand spike. And the third factor,
Just getting clarity on the Section 232 tariffs, those are the steel and aluminum import tariffs. PACCAR estimated they're currently a drag of about $75 million per quarter. Any relief there would flow straight to the bottom line.
okay. So the overall feeling is that the trucking market's excess capacity is slowly working its way out, and there's pent-up replacement demand building, especially with those regulations looming.
That's the gist of it, yeah. Setting up for a stronger 2026 and potentially 2027, driven by that pre-buy.
Right. So pulling this all together, based on the compass scope analysis and everything we've discussed, what are the absolute key things you, the listener, should be watching? The biggest uncertainties?
Okay, top three, I'd say.
Yeah.
Number one, unquestionably, is those regulatory and emission standards, specifically the 2027 EPA NOx rules. They will dictate the timing and, importantly, the size of that pre-buy cycle in 25-26, and also how sharp the drop-off is afterwards.
Makes sense. Timing is everything there. Number two.
Number two is just the basic blocking and tackling, economic growth and freight demand. It's a cyclical business. If the economy tanks or freight volumes stay soft, truck sales will suffer, regardless of regulations.
The macro always matters. And the third key factor.
The big strategic one, adoption of electrification and alternative powertrains.
Yeah.
This is where PACCAR potentially has that competitive disadvantage risk we talked about.
Right.
If EV or maybe even hydrogen adoption happens faster than PACCAR is prepared for, maybe because TCO gets better quicker than expected or infrastructure rolls out, they could lose market share to Daimler Volvo, the ones who bet earlier.
Yeah. Yeah. That feels like the long-term existential question for them. And we should probably also keep an eye on the health of that parts business, making sure it stays strong, and any news on those tariffs, right?
Absolutely. The parts business underpins so much their financial stability, and tariffs are a direct hit to margins currently.
Okay. So to synthesize, PACCAR is this incredibly efficient, financially robust company. They lean heavily on parts and finance to smooth out the cycles. Their conservative style minimizes risk today, maximizes profit today, but it leaves them walking this tightrope regarding future tech investment.
That sums it up well. It's a fascinating balancing act between present profitability and future positioning.
Well, thank you again for sharing those sources. This deep dive into PACCAR really highlights that tension between discipline and disruption.
Indeed. And maybe here's a final thought for you to chew on. Given PACCAR's long history of financial prudence and that big $10 billion cash cushion, what specific future scenario would actually make their conservative bet on technology look like the right call? Think about, say, maybe a much slower EV adoption curve than forecast, or perhaps a deep, prolonged recession that cripples competitors' ability to fund R&D. Under what conditions does PACCAR's patience pay off most handsomely compared to the aggressive spending of its rivals? Something to consider.
This content is produced by compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on compasscope.com.